What's up, folks? This is PubGPS, Financial Wisdom on Tap. Thanks for coming back for episode 2 of the basics. But before we get started, I'd like to introduce you to this bad boy. This is the Wisdom Keg. I think I'm going to nickname this keg Wizzy. So from now on, if you see it, you'll know that this is Wizzy, the Wisdom Keg, bringing some knowledge to you. So, on today's episode, other than watching me pick up barrels, we're going to be talking about investments. Now, this is an illustration, as hokey as it is, that I learned some 15 years ago when I got into the business. And we're going to be breaking down the difference between a stock, a mutual fund, and now we've added to it an ETF, or exchange traded fund. Now, the disclaimer, this is not a recommendation that one of these 3 products is better than the other. This also isn't a recommendation to buy any of the stuff that we're talking about here today. This is illustrative purposes. Thank you. So, our first step is to get drawing. Here is your financial house. Looks pretty good, right? We have 3 big windows in your house. We got this big bay window up here, and then we have these 2 little windows upstairs, and they have some smaller panes. All right, now to help us illustrate, I'm going to make each of these a tiny bit bigger. And let's get started. So you have some pesky neighbors, some kids next door are playing baseball. Maybe it's my kids, all right? And they're going to hit a baseball through one of the windows in your house. Fortunately, you get to pick which window they're going to hit it through. Do we want that ball flying and cracking through the big bay window, where we then have to replace the entire thing? Or do we want it flying through one of the smaller windows, where we only have to get to work and fix one of the smaller panes? Now, an argument could probably be made for any of these, but in today's example, we're going to keep it simple and say that we'd rather have it go through one of the smaller panes because it's easier to replace. This brings us to the difference between these 3 products of the stock, the mutual fund, and the exchange traded fund. We're covering the basics, remember. This isn't fully in depth. When you're owning one single stock, you have to remember that if the ball flies through the window and hits that stock and it's no longer worth owning, you have to sell out the whole stock and then fill it with a whole nother position. You have to buy a whole nother stock. That means that although there's the potential for the reward because you only have that one, there's also the risk that it could be extremely volatile and you have to replace the entire thing. So what do you do when you don't want to put all of your proverbial eggs in one basket? You come over here to the mutual fund. And now, instead of owning just the one, you say, I want to own a basket of them. I would like to have a window of them. So here, instead of owning one company, we'll call it the pub company. You own the pub, and you own the bar, and you own the grill, and you own several other types of companies. So when the one company isn't doing so well, you can swap it out and replace it with something else. Now, you still have the potential for growth, but you're also a lot more diversified than you were over here. Now, a mutual fund acts kind of differently than a stock, because if it's 11 o'clock in the morning and you say, I want out of my mutual fund, I don't want to own it anymore, you have to wait until 4 o'clock to actually, when the market closes, the New York Stock Exchange, to sell out and get the money from that mutual fund. So enter the exchange traded fund. The exchange traded fund acts very similar to the mutual fund, except if it's 11 o'clock in the morning and you say, I need my money back, you're able to sell out of that fund almost immediately, as opposed to waiting until 4 o'clock. Now, the one plug for the emergence of the exchange traded and ETFs is that they typically come or can come in a much lower price tag. So we've seen this slow evolution in the financial industry from relying solely on mutual funds as a way to build wealth to now transitioning into exchange traded funds, because the less that you pay, the more that you keep. And one of the statistics, although I won't give it attribution in today's video, basically says that the the way that you can make the most money, or one of the ways for you to grow wealth, if you only concentrated on that one way, would be to focus on keeping your expenses low and reasonable. So here we have it, our 3 windows for today. Thanks for listening in. Thanks for joining me. I'll see you next time.